Guest joining in, Hiren Ved, CEO, Director and CIO, Alchemy Capital Management. Nikunj in conversation with him. Nikunj?
Hello and welcome to a brand new show of Market Makers. We may be at a relative scale of outperformance given what is happening in the recent world. But given that now markets are perhaps reaching that phase where valuations are not exactly cheap, triggers are absent, and major part of the re-rating in individual stock has already happened. Where do we go from here? What's next in terms of a trigger? What's next in terms of a theme? And what is the way forward for some of the consumer tech and fintech stock after the grand comeback in the first half of 2023? Let's take some of these pointers forward with Hiren Ved of Alchemy Asset Management. Hiren, fantastic to have you back. Thank you for joining us.
Thanks, Nikunj. Always a pleasure.
Likewise, it's turning out to be a good year.
Yes.
When the year started, nobody anticipated any kind of, nobody was prepared for double-digit gains on index and even on individual stocks. But last 4-5 months, I think we've seen a breathtaking rally.
Yes. And you said it right. Not only a breathtaking rally, but the breadth of the rally has been pretty good, right? I think from the Feb-March lows, double-digit plus, right? In the both Nifty and especially small and mid-cap have done exceedingly well. But Nikunj, if you look at a slightly longer term perspective, let's take October 21, which is when markets last peaked, right? The broad markets peaked. It also pretty much coincided with the Fed starting to raise rates, right? That is, I think in November was the first time in 21 when the Fed started talking about raising rates. And the broad markets corrected, right? If you look from October 21 to today, the rise in the market will look less spectacular. And the Nifty, for example, is up 3% CAGR over 21 months from October till date, October 21 to date. The mid-cap index is up 7-8% and the small-cap index is also up 7-8% CAGR. So essentially, you've broken out of a long consolidation phase between October and March this year, and then from April onwards, you've seen a surge. It's also because earnings breadth improved, because 22-23 was a very tough year for earnings, especially the first 9 months after the Russia-Ukraine war. Commodity prices just completely went off the charts, and all manufacturing companies outside of financials was the only pack which did well in terms of earnings, because they had the best metrics that you could think of, best NIMs, no credit cost, reasonably healthy, But outside of financials, there was a big impact on earnings because of rising commodity costs. That was also one of the reasons that you had a double whammy of rising rates globally and falling margins, which is why your broad markets didn't do well in 22. But that is now reversing in 23. You can say that while you don't have while you don't have rate cuts coming as yet, that's kind of got delayed, but at least you are peaking broadly. So you're not going to see rates much higher from here than where you are. And earnings are coming back because commodity prices are starting to come down. So I think this combination has worked for the broader markets. So I'm not surprised that we always have this recency bias, because if in 3-4 months the markets really go up, we feel, oh, markets like too high. But as I said, if you take a slightly longer term view, it's not done anything great for the last 20-22 months, right? Also, if you look at another statistic, right, if you take the BSE 500 earnings pre-COVID, March 2020. I think the figure is somewhere in the region of 4.5 lakh crores. If you take March 23, those same top 500 companies, it's at 11 lakh plus crores. So earnings have more than doubled, but Nifty hasn't doubled from 12 to 24 yet, right? So I think you have to keep some of these things into perspective, that I don't think, yes, we are not cheap, we are not very cheap, but we aren't exorbitantly expensive as well. And there's just so much of gloomy news outside of India that, you feel that how come markets are so resilient?
Okay. Now let's look at three factors which have changed post April. One is liquidity. That good old go to sell India, go to China trade. Every time, I don't know why people do it, but every time they've done that, they've come back and realized they've only come back to buy Indian stocks at higher levels, which is liquidity. That has reversed.
Yeah.
Do you think the broader trend for 2023 could be that, barring few bad days of outflows, in general the trend for global liquidity will be strong and it would be favoring India?
Undoubtedly. I think, the China trade is really not happening. Everybody tried it early this year. They thought with the reopening of China, there'll be a big comeback, and it all fizzled out. And now increasingly, the real estate problems in China, they're trying to artificially stimulate the economy, but it's just not working. And then on top of that, there is the whole geopolitics with the US, etc., which is not helping either, right? But sometimes what happens, Nikunj, is that we all might be very happy that money is flowing out of China, and where else will it go? But when nothing else is doing well and only India is doing well, then India starts on a relative basis seem to be trading at a significant premium to other emerging markets, right? And that also sometimes becomes a constraint, because there may be a set of global investors who may say, yes, we love India, structural growth story is superb, but look at the premium to other emerging markets. Now we as Indians would want to justify, and rightly so, why India should trade at a premium. But sometimes when everything else doesn't do so well, it's always good news for India, because our premium goes up, right?
But this year in Nasdaq is also done well, 44% up. So while we may say that, okay, India is up, it's been a good year for global equities in general, barring one or two markets here or there.
Yeah, in fact, India in dollar terms is underperformed, right?
Exactly.
I mean, it's not that.
There's nothing to get excited about.
Yeah, I mean, that's why I said in nominal terms, we are getting very excited about, because we are coming from a fairly low base and depressed base of 2022. I don't think we've done anything great, earth-shaking. I think the best of the rally is still ahead of us.
So if I say India is like a sea-facing flat in Nariman Point, it will always command a premium because of the positioning of the flat.
Yes.
And that is the positioning of Indian economy, Indian stock markets. It will always command at a premium.
Yes.
So everybody thinks that China is cheap.
Yeah.
And others offer better value. Remember, Nariman Point has commanded a premium, will always command a premium.
Absolutely. And I think we have to be less defensive about this fact. We become too defensive when all the strategists come and write reports and say, oh, India is trading at a significant premium, and there is a lot of value in China. Yeah, I mean, we've seen markets that we see markets that have come into its own. We've had those markets trade at a premium for decades together. And
Japan traded, US traded,
Japan traded, US traded, China traded in a similar manner. It could well be India's decade now. It is. It not could be, it is. Okay. So I think we have to get used to this.
So the messaging for our viewers who are watching the show, that okay, you look at market from point to point, which is April low to now, it's a double-digit rally. But if you stretch the timeline, maybe add in one more year, maybe add in 5 more quarters, it's actually not a powerful rally, which means that there is no euphoria, there is no excitement, and there is no bubble in the market. That's the headline message number one.
Yes. Just to add, Nikunj, to that point and to the viewers as well, right? If you look at the Nifty mid cap and the Nifty small cap 1 year forward earnings,
Is it FY25?
FY25.
Okay.
You are today trading at lower levels than October 21 levels for all the three indices, and we are exactly near 5-year averages. So you do the math, the 5-year Nifty forward and where we are trading today, we are at near 5-year averages. Now, if we believe that the next 5 years, our earnings growth, our return on equity is going to be worse off than the last 5 years, then it's a different question. But I think otherwise, right, the next 5 years could be better than what we've seen in the last 5 years, because last 5 years we've seen a lot of disruption, COVID, and so on and so forth. I think we're not terribly expensive at all. We're trading at 5-year averages.
So let's do a maths here. If earnings are expected to grow in the range of about 12 to 14%, 12 being the base and 14 being the optimistic number, can one expect that in 3.5 to 4 years, which is simple rate of compounding, the Sensex should be close to 1 lakh? It may not be above 1 lakh, it may be just below 1 lakh, but there is a serious possibility and a probability that 3 to 4 years Sensex 1 lakh ho jayega.
I have no doubt, right? And again, when we talk about earnings compounding, Nikunj, we talk about the Nifty, right? Typically. My sense is that the broader markets, if you look at the NSE 500 or the BSE 500, my sense is that the broader markets earnings could compound faster than the Nifty. Because the Nifty has a lot of heavyweights and they may compound at 14-15%, but the smaller companies might compound faster. Manufacturing. See, the representation of the sectors which are likely to outperform over the next 5-7 years in the Nifty is far lower. Like auto and pharma are have virtually no weight in the index. But if autos outperform next 5 year or manufacturing outperforms, they could run at a faster pace than what the Nifty could run. So the Nifty representation is so overloaded in favor of financials that the smaller and the broader manufacturing side of the market could grow much faster in earnings.
At what rate do you expect your portfolio earnings to compound? Not the pricing, but the portfolio earnings to compound.
So if you look at our portfolio today for the next 2 years, CAGR is 25% earnings growth.
25%.
25%.
What are your top holdings?
Sorry?
What are your top holdings? So you expected 25% CAGR.
So we have everything from large, mid, and small cap, Nikunj. Yes, we have NBFCs and financials at the top, but we also have consumer companies like United Spirits is part of my top 5.
The numbers are
Varun Beverages are top 5. And we have now stocks like Larsen, which are way up in the pecking order, right? Because we believe that the capital, both the government and private capex will play off. We have technology, mid-cap tech in our top 5-10, right? So we have, we don't look like the index at all in our top 5-10. And then over time we have invested in a lot of manufacturing companies, bearing companies, capital goods, power equipment, and so on and so forth. We think there the earnings could be much faster. And as I said, our weighted average portfolio earnings growth is going to be on top, ahead of 25% for the next 2 years.
Is L&T the only Nifty 50 company in your top 5?
No, we have others. We have private. We have ICICI Bank. We have Bajaj Finance, and L&T. These are probably the 3 from the Nifty that we have. Everything else is outside the Nifty.
I distinctly remember that when we met in December, you said you bought into Zomato. You bought into Paytm.
Yeah.
And it must be a painful position because post December those stocks they fell another 20%, another 25%. But the tide has turned.
Yes.
For Paytm, Italy, and for Zomato and for Policy Bazaar. Are best of the gains behind them?
No, I think the story is just about getting started.
For all of them, or just anything specific?
No, I think specifically, we're bullish on Paytm and Zomato. We also like Policy Bazaar. We're also playing some of these through Info Edge because that has a cash flow business plus a holding in that, right? But I think that these businesses have a long runway for growth. Just like the FMCG companies in the 80s had a long runway for growth, right? I can't see too many businesses compounding at 30-35% top line.
Very few actually.
Very few, right? But Zomato could compound top line for the next couple of years. And if they start becoming more profitable than what they are today, then I think that's where the value, that's where the money is going to be made.
Operating leverage will.
The operating leverage should kick in. They're becoming more disciplined about their capital allocation. They are focusing on profitability and cash flows. And they have leading positions in their respective sectors. I mean, it's a duopoly now between Swiggy and Zomato. And I think Zomato has a slight edge over Swiggy. And in payments, Paytm has created a fantastic platform. And everybody is now realizing the value of payments, though it doesn't make great money, it makes some money. But it's what you cross-sell to your payments customer is where you actually make money. And that's what Paytm is doing by lending. There are 8-9 NBFCs behind that. But they have the platform and the data to lend to these individuals, and they're building a book and they're making money on that. Right.
The market cap of a Zomato is almost $9-10 billion. Paytm nearing there in terms of a market cap. So while the growth may be visible, and in terms of a need and what they would do in terms of creating a community and also ecosystem is going to be very large. But if you're looking at the market caps, 70,000 crore, nearing $10 billion for Zomato, aren't these stocks then priced to perfection purely based on the market cap versus the size of the opportunity?
Nikunj, we have to, if we are talking about our economy being 5 and 6 trillion, what is 50, 60, 70,000 crores? We have to grow out of these numbers. We are not
think big
in the 2000s, right? Where a 1 lakh crore market cap seemed so big, right? By international standards, our large caps are mid caps, right? Even the Reliances of the world at 16, I mean, the real big caps in the US have crossed $1 trillion in market cap, right? You have to look at it in the context of first of all, if for the whole of the country there are going to be only 2 food delivery companies, then the opportunity is much bigger, right? And today maybe 100 million customers out of 1.4 billion are using a service like this. 5 years out, 200 million, 250 million of the middle class households that we talk about might use that, and then the frequency of use might improve. So I think there is significant runway for growth, right? I think the problem was that the market caps at which they went public were wrong, clearly, right? Because the valuations in post-COVID in 2021 for everything that was digital was just way out of whack. I think we've come down, there's more rationality in valuations. So you have to look at from here where, and I think there is reasonable runway for growth.
Okay, we spoke about the following. You like manufacturing?
Yeah.
You were bullish on the EV capex, and you were bullish on the energy transition. And some select consumer tech names, which you already have discussed, Paytm and Zomato. How are you betting on manufacturing? Is L&T the easiest way to bet on manufacturing?
No, Nikunj, I think, manufacturing is a very broad term. My sense is that the kind of sectors which led between 2003 to 2008, but with a couple of more sectors added in this cycle, like you mentioned, electric vehicles and that entire ecosystem, or energy transition and that entire ecosystem, right? Infrastructure, which is being driven by the government at this point in time, whether it is railways, defense, etc. So manufacturing is a very broad theme. I mean, when you say EV, you don't have to necessarily go and directly buy an EV OEM. You could buy an ancillary which is supplying or which is very well positioned
Have you
for
done that?
EV. We've done that. I mean, Sundaram Fasteners has, have $400 million of orders for supplying EV.
You've been holding on to Sundram Fastness for more than 10 years now, right?
Yes. And they've transitioned pretty well.
Looking at data, the CAGR return in the last 20 years for Sundram Fasteners is 20%.
Yeah.
One of the most underappreciated stock where they're giving you 20% return without dilution. And
At all.
Yeah, and nothing really great, iconic about that business. But they keep on doing the same thing again and again, and they have this habit of getting it right.
I think they're a great manufacturing company. People forget that when you looked at the manufacturing icons in India, Sundaram Fasteners, stands out with all 17 plants having won the Deming Award, which is the highest quality award that you can think of. And they were largely a commercial vehicle fastener company. Today, that's just 20% of the business, right? They do fasteners for windmills, right? So that's, for me, an indirect way to play the energy transition. You may not buy the end equipment guy, but you're buying into somebody who's supplying into renewable energy. They're already supplying to EVs, they're already supplying to fasteners to the windmills, and they will do more in aerospace, etc. You have the same manufacturing skill sets, but you have far more opportunities to earn your revenue from. So I think a lot of those kind of plays have found our way into our, you look at the bearing companies, right? I mean, they also go in auto, but then they also go in railways and industrial. So you can play all three sectors by buying into one bearing company. Right?
Would you make manufacturing and alternate energy as 20-25% of your core portfolio? Like, could this be the outsized bet? Let's say you took in NBFCs in 2010 and 2015. Could this be at the core of your portfolio?
I think that entire cohort of capital goods, infrastructure, energy, auto ancillaries, defense, all of that put together is clearly the largest portion of the portfolio. You call it industrials if you have to, right, which is manufacturing or industrials. I think that is a core of our portfolio now for the next couple of years.
Are you bullish on L&T because of the capex? But L&T also has IT.
Yeah.
And those IT companies are going through their own cycle of disruptive AI impact. What is your view there?
Well, now 35% of the value of L&T comes from the investments that they made. As a shareholder of L&T, I'm happy they made investments in those businesses because they are not working capital intensive. In fact, they throw cash flows and they're compounding at 15-20% a year. So 35% of L&T's value is compounding nicely at 15, 20, 25% a year. I'm quite happy. I'm not as bearish on tech as most people are. Yes, we are going through a slowdown patch, but my sense is that AI will actually accelerate tech spending. I think that every company will have to adapt AI into their processes, and they will need products and tools and Indian IT services companies to help them to use that AI into their businesses, right? So I think AI with a little bit of lag, and we are already starting to see that, if you look at some of the hyperscalers in the US, they are talking about cloud spending coming back in a big way. Yes, everybody was a little cautious because we made such a big din about a recession in the US and Europe. And therefore, people just held back decision making. They held back a little bit of budgets. But the US economy isn't slowing down. Even the last data that came yesterday was better than what most people expected. So I think in a quarter or two, tech spending will come back because you can't hold it back for too long a period of time. But I think otherwise L&T is changed dramatically. From being an asset owner, they are again becoming an asset light business. They are in every area that we are bullish on, whether it is railways, defense. They are also doing stuff in hydrogen, oil and gas, EPC, renewables, building construction, And they're still one of the few companies who can do complex, large infrastructure projects.
Okay, that's Hiren Ved from Alchemy Capital talking about a whole host of sectors and his opinion on individual stocks as well. Let's take stock of where the market has settled.